Hello. Good evening, everyone.
Hello, Mr. Tolu.
Good evening, sir.
Yeah, good evening. Welcome to the class.
Okay, sir. Good evening, sir. Okay. Okay, good evening, Mr. Owolaju Martin.
Yeah, you can share your screen. I've not been able to see your screen.
Okay, I'll share it. Okay. Okay. Can you see my screen now?
Yes, we can see.
Okay. Thank you.
All right,
Sir.
thank you. Welcome.
Okay, Mr. Owolaju, can you hear me? And can you see my screen? Just like to hear if you can, if I can go on.
Sorry, I didn't hear you.
Yes, I can see your screen. I can hear you.
Okay. Thank you very much. I just wanted to know that you are here. So my name is Tolu, and I am going to be taking you financial accounting today, and we are going to be treating IAS2 inventory. And I will just, if you, as I go on in this class, if you would like me to go over something again, you can just do a thumbs up in the chat section so as to allow me, or you can just ask me as we go on in the class. Please, my aim is to make sure that I pass the knowledge required and that you get everything that I'm going to be sharing today. If you are clear with that, can I go on with the class?
Yes.
Okay. So today we'll be talking about IAS2. And IAS2 talks about inventory. And when we talk about inventory, when we say IAS2, it means International Accounting Standard. Because in preparation of financial statements, that is your profit and loss and your statement of financial position, we have international accounting standards that deals with different ways we treat financial transactions in our financial statement. And this is one of the international accounting standard, which is IAS2. And this IAS2 covers everything about inventory, covers how we recognize inventory in our financial statement, as regards how we recognize inventory in our profit and loss account, how we recognize inventory in our statement of financial position, how we value inventory, what are the things that represent inventory. I know before now you have had what we call inventory. If you have not had it, you have one time or the other had someone say something about inventory. So there's a standard. There's an international accounting standard that talks about inventory, and that is IAS2. But what is this inventory itself? What makes inventory different from every other thing? What are the things that makes up inventory? We said inventory means tangible property held, one, for sale in ordinary course of business. So if you have anything that is for sale, majorly for sale, that is the goods that you buy into your store to sell, we call those things inventory. So we are saying, based on international accounting standard, they say that inventory is a tangible property. You can see tangible, so it's not intangible. So when you are selling something that is intangible, it must be tangible. So say for sale in ordinary course of business. So during ordinary course of business, like someone who is selling, for example, who is selling book items, the book items are classified as the inventory of that particular person. If the person is selling drinks, soft drinks, bottled water, the inventory of that person is what? Is the bottled water and the soft drink. We said in the process of production. So inventory is not only limited to the tangible property that are held for sale in an ordinary course of business. It also means a tangible property held in the process of production. So in the process of production, we understand that, for example, if you are to make, something like soft drink, we know the process. So we have raw material. Or for example, you are trying to produce cement, we understand that limestone is a raw material. So that limestone is also an inventory. So inventory is not only limited to the scope of finished goods alone, like for example the soft drink or the cement. We say all the things that make up the production of the cement and the soft drink are can be classified as what? Inventory. And the last one is all for the consumption in the production of goods or service for sale. Hence, after seeing all these definitions as stated by IAS, we can conclude that our inventory includes stock of what? Raw material and component. Like I told you, that inventory is the tangible property that is held during the course of a production process. So we have raw material during a production process. So we are saying that our raw material is classified as what? Inventory. Our work in progress is also classified as inventory. For example, uh, uh, the limestone, maybe when the limestone is born, before it finally gets to the process of becoming a cement, you understand that maybe there might be need for crushing, there might be need for doing some sort of things to it. And at some point you need to transfer it to another factory. For example, I can use the nylon production business that I'm so familiar about. For example, we have the raw material, which are the resins. For example, the high density polyethylene resins. Those ones, they will be crushed, they will be melted, and it will become like rolls. So you will have rolls. Those rows can be classified as work in progress. Then after making the rows, you now transfer it to where the rows will be cut into shapes and sizes. So before it now becomes finished goods. So the rows can be classified as what? As the work in progress. And we also said inventory also includes stock of what? Of finished goods. So we are looking at, in case of a manufacturing company, we are not just limiting the definition of inventory to only finished goods. Like for example, if you are producing cement, we are not only limiting the definition of inventory to the cement itself. We are saying during the production process, we will have what we call the raw material, we will have what we call the work in progress, and we also have what we call the finished good. All those things combined together are what we call what? Inventory. Are you getting me? Now, we said, what is the objective of inventory valuation? Why must we value our inventory? Why must we put a value on our inventory? We said number one, determination of income. For example, in determining your income, for example, you need, for example, when you are preparing your profit and loss account, you need your cost of sales, and that cost of sales, before you can get your cost of sale, we say cost of sale is opening stock, you add your purchases, then you less your closing stock. Now you will subtract your cost of sales from your sales to get what? Your gross profit. Now, in determining the income of a business, we need to be able to value our what? Our inventory, because our inventory comprises of what? Of our cost of sales, is what makes up our cost of sale. So if you don't know how to value your closing stock, for example, maybe at the end of the year, you have inventory like finished goods. When you are preparing your financial statement for the year ended 31st December 2020, and you have some goods left as at 31st December 2020, how do you value this inventory? Because that is what will make up your cost of sale, that will allow you to know, okay, this is what I have made in this year. So one of the objectives of inventory valuation is, one, to be able to determine our income. Because if we can't get our cost of sales, we cannot be able to derive what is the gross profit of the company. And when we cannot get gross profit, we cannot know the net profit. So that is one of the reasons why we value our inventory. Then B, we said determination of financial position. Determination of financial position. Now, our closing stock of inventory, our closing stock of inventory forms an asset, part of the asset of what? Of the company, of the business, the current asset, because we understand that that is why it's in current assets, because we understand that the company, the business will use it up within 1 year. When you say current asset, is an asset of a company that is expected to be used up within 1 year. So we are saying that, for example, determination of financial position, we need our inventory. We need evaluation to value our inventory to be able to know the financial position of the company, because you cannot just say that you have every other parameters and you are not including your inventory, the value of your inventory, because it forms, it shows that, oh, this is the financial position of this company. This is the financial position of the company. So it's very important. Looking at what is here, we said in the financial position, inventory is a very important item. It is shown as current asset in the statement of financial position at the end of your current asset in the statement of financial position. And that is why we need it to determine our financial position. Are you getting me? Now, okay. Do you understand? Okay. So,
Yes.
okay. So, okay. Thank you very much. Okay. So we have methods of recording inventory. How do we record this inventory in our book? Yeah, we said one, we have the inventory system. We said under this system, the quantity and the value of inventory is ascertained by physically counting the stock at the end of the year and as on the accounting. When we talk about the period inventory, we are counting period. If you of every year, maybe less 20. The accounting period, if your accounting period is from 1st January to 31st December. So if you are doing a periodic inventory, if you are recording using periodic inventory system, that means you are going to physically be counting your stock at the end of the year. So in cases of big business house, annual stock taking at the end of the year in finishing the stock in hand on continuous basis. So we are going to show these two inventory styles with this question. But let's look at the second one, the perpetual inventory system. The perpetual inventory system provides as running record of inventories on hand, because under this method, stock registered and maintained, which will give the inventory balance at any time desired. So as compared to the periodic one, the periodic inventory system is as at the end of the accounting period. You just for you to be able to ascertain your inventory, you do what? You do a physical stock counting. But this perpetual inventory system, there's an inventory record. Time to time, you know, okay, this is what we have as our inventory, as our stock at hand. You see, according to the Institute of Cost and Management Accountants in London, it is a system of record maintained by the controlling department, which reflect the physical movement of stock and their current balance. So in this perpetual inventory system, it is easy to control. You can know there's a system of recording the movement, how your raw material is being used, how you, what you have as your work in progress, what you have as your finished goods. Under the perpetual inventory system, you can easily detect fraud and theft. But under the periodic inventory system, this might not be possible because you will be waiting till the end of the year to do what? Your physical count, to know what? To know the balance of your inventory. Do you understand? But under the perpetual inventory system, it's like it's part of the process of the organization that when inventory comes in, there is a record. And I think most times companies use both the perpetual inventory system and the periodic in the sense that they have a record, and even at the end of the year, they still do what? A physical counting. So let's look at this question to be able to show us how these two methods can be used. Looking at this question, they said FCA trading had opening inventory of 20,000. Purchases during the year were 60,000. Closing inventory at the end of year two was 24,000. At the year end, the following entries are necessary. Show the accounting procedure using the two methods. So if you are to use the periodic method, in this periodic method that we have is that we will not just have one single inventory account. We will have the purchase account, we will have the inventory account, we have the cost of sales account. Are you getting it? As compared to the perpetual method. As compared to the perpetual method that we just need to have only what? Only just the inventory account. Looking at this, you can see purchase account. We see the debit and credit side. You can see the purchase account. We purchased bank 60,000. We know that they make understand that cost of sales is different from purchases. What makes up your cost of sales is your opening stock purchases, your opening stock add purchases, then less your closing stock. So you can see that the cost of sales is not just purchases. You don't mistake purchases for cost of sale. And that is why you will see from here that we have debit bank 60,000, and we see that the purchase account, we can see that 60,000 is taken to where? To our cost of sales. This 60,000 to net off the purchases account. And if you see our inventory account, you can see the opening balance 20,000, which reflects what? FCA trading opening inventory. You can see 20,000 debited. You can see you can also see that the cost of sales, you can see the balance, our closing balance inventory at the end of year two is what? Is 24,000 naira. The inventory account, the opening balance goes to the cost of sales. The same way purchases too goes to the cost of sales. Because the cost of sales, I told you, is the makeup of opening stock, purchases, and closing stock. For different companies, there are some other components that make up their cost of sales. Then we move down to cost of sales account. You can see the opening stock, opening balance 20,000. You can see the purchases. It just gives us an idea of opening stock, add purchases. You can see 80,000. Then do what? Less closing stock, showing us that our cost of sale for the year is what? 56,000 naira. You can see the transfer of from purchases and inventory. Everything is moving to your cost of sales account. But you can see the inventory account as compared using the periodic method of recording. You can see what you have to have a purchase account, the inventory account, and the cost of sales account, this transfer. But under the perpetual recording account, perpetual recording method, you just have one account, which is the inventory account. You can see opening balance 20,000 of inventory, bank, which is purchases 60,000. When you remove your closing balance from it, you have what? Your cost of sales, which is this 56,000. So it will not require what? It will not require all these additional accounts. That is the purchase account, the cost of sales account, and the inventory account. Please, if you have any question, do not hesitate to let me know. If you have any question, please do not hesitate to let me know. So we move to the next question, which is Oniyale had opening inventory of 100,000. Purchases during the year were 500,000. Inventory with a cost of 18,000 was returned to a supplier. One of the purchases in the above amount was subject to an express delivery fee, which cost the company an extra 15,000 in addition to the above amount. Omiyale sold goods during the year which had cost 520. Goods which had cost 20,000 were returned to the company. Just before the year end, goods had cost 5,000. Just before the year end, goods which had cost 5,000 were found to have been damaged whilst being handled by Oniyale staff. What are the entries during the period using perpetual method? Like I told you, under the perpetual method, you don't need to prepare all the accounts. You just need what? Just one account, which is the inventory account. You can see the opening balance 100,000. Now purchases is what? 500,000 naira. Delivery fee is what? 15,000 naira. Return inward, people return in items. Now understand that I told you from beginning that the inventory is a current account, and when you debit a current account, that means you are doing what? You are increasing it. And when you credit a current account, an asset account, when you debit an asset account, you are increasing it. When you credit an asset, you are reducing it. So let's see it. Opening balance, that is 100. When you purchase inventory, are you not increasing your inventory? That is why we are doing what? We are crediting this account with 500,000. Then delivery fee. One of the purchases in the above amount was subject to an express fee, which cost the company an extra 15,000. Returning what? People brought in goods back into the company. You are increasing it. We have 635,000 naira. Now, supplier return is what? 18,000. You say inventory with cost of 18,000 was returned to a supplier. That means we are doing what? We want to reduce this inventory account. What do? We credit it because it's an asset account. That means you are doing what? Return outward. Return outward will be what? Will be credited. Normal loss will be what? Will also be credited, because this one will reduce what? The stock of your inventory. Then what? What is the closing balance? They said Oniale sold. Sales is 520. How do you know your closing balance? When you subtract the total year from your debit, you get your closing balance, which is what? 92,000 naira. Now, you can see these are the accounting entries. These are the accounting entries. Because they told us that Oniyale sold goods during the year, which had cost 520, they didn't tell us that it was a cash sales. So what do? Sales, you will debit receivables account and credit what? Revenues account. Because what? Cash was not transferred. If cash was collected during the sales transaction, what we will have done is was to do what? Debit your bank and do what? Credit your sales account. Are you getting it now? Then what is the next thing? You debit your cost of sales and credit what? Inventory. Now, goods returned to supplier. How do we treat it? We debit payables. We debit payables and credit what? Return inwards. Why are we debiting payables? We are reducing what we are owing our suppliers, because now looking at it, they say we purchased 500,000. We are not told maybe it's cash that we use in purchasing these goods that we purchased, this 500,000. So what do? Payables, debit payables for the 18,000 naira and do what? And credit return inwards. And what do you do again? You debit cost of sales. You add it to your cost of sales and credit inventory. That is what we did here, credit inventory account. Now, for goods returned by customer, we said debit return outward and credit receivables. That is, people who you have sold for, you will reduce it. You will reduce the people you have sold for that you already debited the receivables account. You are going to credit it back. That is, you are going to reduce it by the amount. By the amount of what? By the amount of this 20,000 naira. Now you will now debit return outwards. Then what do you do next? You debit inventory and credit cost of sales. Now we have, what are the methods of valuation of inventory? Now, the valuation of inventory can be extremely important for financial reporting. What we have just done previously is to show us how we record our inventory, the ways we can record our inventory. We said the perpetual method and the periodic method. Now we want to see how do we value our inventory. We want to see how do we value our inventory. Of cost and net realizable value. Lower of cost and net realizable value. Now, what is the cost of our inventory? Because we have to understand what cost is before you can, and net realizable value is, before you can pick which one is lower. So when you are presenting, when you are valuing your closing stock, because we recognize that your closing stock this year is what will represent what your opening stock. So invariably, we are saying in valuing our stock generally, our inventory generally, we comprises of both your raw material, work in progress, and finished goods. You must take into consideration what? Your cost and net realizable value. Which one is lower? Whichever one is lower is what you will use in valuing what? Your inventory, in your statement, in your financial statement. Now, what comprises of stock of the cost? We said according to IAS 2, historic cost is the aggregate of what? Of cost of purchases, cost of conversion, and other costs incurred in the normal course of the business. So our costs represents what? Your cost of purchase, cost of conversion, cost of manufacturing company. We are saying that your cost, the cost of your inventory is what? Your cost of production. Should also be your purchases plus what? Your cost of production. That is your direct labor. Are you getting it? The factory overhead, the factory overhead. All these represent what? The cost, the cost of conversion. Another cost incurred in the normal course of the business in bringing the inventories to their present locations and condition. So cost of purchases comprises purchase price, duties and tax, freight inwards and other expenditure directly attributable to the acquisition. So for example, you must understand what are the costs that are directly attributable to bringing this inventory into into our store or into our company. For example, the cost of transporting, that is inventory should form what? Part of the cost of that inventory. So that is why we said any cost directly attributable, that is any cost that it was because of the purchase of our inventory, that was the reason why you incurred that cost. So if you were not bringing inventory into the company, you would not have needed to pay for transportation costs. If you had not, if you didn't need to import your inventory, your raw material from UK down to Nigeria, you might not need to pay some import duties. We are saying any cost directly attributable to the cost directly attributable to the acquisition of this should form the cost of the inventory. So we are saying, for example, the purchase price, the duties and taxes, freight inwards, and other expenditure. You can see ISU is putting other expenditure directly attributable to the acquisition. So, however, selling expenses such as advertisement expense or storage costs should not be included. So you might have a question, the examiner might want to confuse you. They might put administrative staff salary or driver, the driver that brought the payment of the salary of the driver that brought in the goods. No, it should not be added to the cost of that good. Only the transportation cost of bringing the goods, the inventory, to your store or to the company should be considered as the cost of the inventory. So let's look at this question to show us what we really mean at cost. Question: Kumo Consumer Electrics buys a cools from an overseas supplier. It has recently taken delivery of 1,000 units of the component X. The quoted price of the component X was 1,200 per unit, but KCE has negotiated a trade discount of 5% due to the size of the order. The supplier offers an early settlement discount of 2% for payment with 30 days, and KCE intends to achieve this. Import duties of 16 naira per unit must be paid before the goods are released through custom. Once the goods are released through custom, KCE must pay a delivery cost of 5,000 to have the components taken to its warehouse. Calculate the cost of the inventory. Number one, what is the cost? I told you that the cost of the inventory comprises of what? Of the purchase price, cost of conversion, and import duties and freights, and what? Any cost directly attributable to the cost of the asset. Looking at this now, they said what? They are giving them what? A trade discount of 5%. That is why we are doing 1,000 times 1,2 times 95%. Removing what? The 5%. So what they are actually going to pay is what? 1,140,000. Import duties is directly attributable, which is 16 naira. It should form part of the cost of the asset. Then what? delivery cost of what? Of 5,000 naira, which is 1,205,000 naira. Any question?
No question. No question.
Okay. Okay, you have a question? Okay, you can just you can type your question in the chat box, and I can maybe at the end of the class before the end of the class I would give answers to those questions so that now we have the conversion cost. We have the conversion cost. I told you I told you that the cost of any inventory is what? The purchase price conversion cost. That is in terms of a manufacturing company. For example, you can see here they are saying conversion cost when material purchased from supplier converted into another product in a manufacturer assembly operation. There are also a conversion cost to add to the purchase price. So we are saying cost directly related to the units of production. You can say direct material. We said fixed and variable production overhead. Fixed and variable production overhead. Fixed and variable production overhead, and any other costs incurred in bringing the inventory to their present location and condition. Now look at these. They say fixed variable production overhead, which must be allocated to cost of the item produced and closing inventory. Fixed production overhead must be allocated to the cost of finished output and closing inventory on the basis of normal production capacity in the period. So let's look at this question to show us how we can check the cost using when we have a manufacturing company. KCE manufactures control units for air conditioning system. The following information is relevant. Each control unit requires the following: one component X at cost 1,205 each, and one component Y at cost 800 each. Sundry raw material at a cost of 150. The company faces the following monthly expenses: factory rent, energy cost, selling and administrative costs. And watch, each unit takes 2 hours to assemble. Production workers are paid 300 naira per hour. Production overheads are absorbed into units of production using a hourly rate. The normal level of production per month is 1,000 hours. So to calculate the cost of what? Of a single unit, we have what? Component X, because it requires what? One component X and one component Y and other raw material. So you can see component X, component Y. Then you can see labor cost. Labor cost. Each unit takes 2 hours to assemble. So it will be 2 times 300, which is 600. Now, production overhead are absorbed into units of production using an hourly rate. So these are the production overhead, factory rent, and the energy cost. You can see 16 plus 75. They are absorbed using what? The normal production level, which is 1,000 times 2 to give us 48. So the total cost of the inventory is what? 2,803 using what? Conversion cost. Using conversion cost. You know, I told you that when we are valuing our inventory, IS2 told us that we should use what? Our cost, or what? or the lower of cost and net realizable value. We have dealt with cost now. We want to look at what is net realizable value. We said according to IES2, the net realizable value means the estimate selling price in the ordinary course of business, costs of completion, and less cost necessary to be incurred in order to make the sales. So we are saying for net realizable value, what we mean as net realizable value is our sales price less any other cost that needs to be incurred in selling that particular good. For example, if for example you want to sell something, for example a land, and it will require doing an agreement, doing a memorandum, maybe you need an agreement, the cost of legal fee and all those things. All those costs needs to be done for you to be able to sell what? That land. The same thing with your inventory. What are the things that need to be done? Is there advertisement? Is there any that needs to be done for you to sell that item of inventory? You subtract it from your selling price, then you now get what? Your net realizable value. So we said net realizable value is the amount that can be obtained from selling the inventory in the normal course of business, less any further cost that will be incurred in getting it ready for sale or disposal. So we are saying net realizable value is usually higher than cost. Inventory is therefore usually valued at cost. It's just simple. So most times inventory is always valued at cost because cost is always lower than net realizable value. But we have cases where the net realizable value is lower than what? Than the cost. That case is when what? The goods are obsolete. Maybe you left the goods in your store and the goods went what? You lower than the amount you bought it. That is when you can use the net realizable value to value what? Your stock, to represent what? Your closing stock, both in your statement of profit or loss, or in your statement of financial position. Or maybe there is a change in technology. You will bear me witness that nobody is ready to use all these desktop that looks like TV again. For example, if you are in computer village and you have that as part of your inventory, I know you will agree with me that you cannot sell those inventory now at the price at the prevailing you will sell it below what you bought it, because what? Technology has advanced. People now want to use slimmer and sleeker what? Laptops. So nobody wants to use what? A desktop that is even not, that does not have flat screen, but the TV kind of desktop. So all these things can bring rise to the for you to use the net realizable value to what? To value your inventory. To value your inventory. Those are the cases whereby you can value your inventory with net realizable value. But beyond, aside from this, most times we use what? We use cost to value our inventory. Looking at this example, we said a business has two items of inventory. A count of the inventory has established that the amount of inventory currently held at cost are as follows. You can see inventory item A and inventory item B. You can see the cost of the inventory, but we are given the sales and the selling price. I told you to get, and the selling cost. To get net realizable value is your sales minus what? The cost you need to incur that inventory. Looking at this now, can someone give me the one that is lower? If you are to value A and B, what will you use? You can tell me that in the chat box. You can tell me that in the chat box. If you are to value inventory A or B, what will you use? Will you be using cost or net realizable value, or you'll be using the net realizable value? Can I get answers from our chat box just to make me understand that you guys are following me. Can I get responses in the chat box? Chat box. Okay. Oluwatubosun is saying that A will use what? Will use net realizable value. Oh, thank you. A will use net realizable value, Gina, and B will use cost. Very correct. Very correct. Thank you very much. It shows that you guys are really following. So A will use what? Net realizable value, because net realizable value is lower, and B will use cost because cost is what? Is lower. Thank you very much. It shows that you are following. Now we have these cost formulas. Cost formulas. We have the first in, first out. We have what? The last in, last out. And we have the weighted average. We also have the weighted average cost. Now, in the first in, first out, this is the method with the assumption that material which are purchased first are the first that will be issued. Materials which are purchased first are the first that will be issued. So, for example, if for this year, maybe you are looking at the accounting year 2020, you bought goods in January, you bought goods in February, you bought goods in March. The first in, first out assumption is that it is the goods that you bought in March, in February, in January that will first be issued before you issue the one in February, before you issue the one in March. So that when you are calculating the cost, if for example you bought 200 in January, 200 in February, and 200 in March, and you have issued 300, using the first in, first out assumption, it is assumed that you have issued what? The 200 of January. It is remaining what? 100 from February and 200 from March. So in calculating your cost, it will just be what? The cost of 100 in 2000 in February, and the cost of 100 in February and the cost of 200 in March to calculate what? Your closing stock. We will see that in examples. So for example, you can see here the following is the record of receipt of certain materials during the month of January 2006. January 2006. January 2nd, we receive 500 at 20 naira. January 3rd, receive 400 units at 21. January 15th, receive 300 units at 19 naira per unit. January 28th, we receive 400 units at 20 naira per unit. During the month, it sold what? 600 units as follows. We want to know what will now be what? Our closing stock. Using first in, first out. You can see the analysis. You can see January 2nd, 520. 500 times 20 will give you 1,000. That is what will be your balance. January 3rd, we also purchase. We now have as at January 3rd, our quantity is what? 900. And the balance, the cost is 9,400. Adding 8,400 and 1,000, it will give you 9,400. Do you understand? Now, in January 5, we issued 100. This 100, since we are using first in, first out, what do we use? It is assumed that the 100 will be from what? From the 500. So the cost will be what? 20 naira. So looking at that, the balance of our inventory will now be what? 800, with the value to be 7,400. That's what? 2,000 minus 94. 2,000 minus 94. Now we move forward. January 5, January 15, they also bought again. That's 300. So 300 plus 800 will give us 1,1. And 57 plus 74 will give us what? 13,100. 13,100. Are you getting it? Now, in January 17, they did what? They issued 400. We still have a balance of what? We still have a balance of 400 from what was purchased in January 2. So the cost will still be what? Will still be 20. Will still be 20, sorry. Will still be 20. 400 times 20 will give you 8,000. 8,000 minus 13,100 will be 3,000. And this 3,000 will be will comprise of what? Of the 400 in January 3 and what? The 400 in January 3 and the 300. So you can see they purchased, the total was 500. So you can see 400 that was remaining in January 2 and 100 that was remaining in January 3. That's why you can see 20 and 21. It is assumed that it's here. It's from this 400 that we pick this 100. So if you had 8,000 plus 2,1, that's 10,001 minus 13,001, it will give you what? 3,000. So this 600 will be for what? 300 in January 3 and 300 in January 15. Then in January 28, we bought 400. That is to give you 3,000 plus 8,000 will give you what? 11,000 naira. Last in, last out is assumed that last in, first out is assumed that the last are issued first. But this method is not allowed by International Financial Reporting Standard. The next method is what? Is weighted average cost. Under this method, the quantity of material purchased in various lots of purchases considered as weighted while pricing the materials. Weighted average price is calculated. We will use this example to show you what? To show you both FIFO and an average weighted average cost. Excuse me, please. Let me go to the solution. Sorry, please. Can you still see my screen?
Yes, we can see your screen.
Okay. So we can see the question. The question is, on 1st January, a company had an opening inventory of 100 units, which cost 50 naira each. During the month, it made the following purchases. This is the purchases the company made. And during the year, it sold 800 units. And this is what the analysis of how it was sold. Using FIFO and AVCO, prepare the ledger card for the inventory. Now, using the FIFO. Now, on 1st January, they had a balance of what? Of 100, which was bought at what? 50 naira. The balance will be what? The 100 times 50 will give you what? 5,000. Now, on April, 5th of April, they purchased 300 at 60 naira. 300 times 60 will give you what? 18,000. 18 plus 5,000 will give you what? 23,000. And the quantity we have will be what? 300 plus what? Was on plus 100, which will give you what? 400. And this 400 comprises of what? Of what we bought at 50 naira and what we bought at 60 naira. In 9th of April, they what? They sold what? 200 units. But since we are using first in, first out, it is assumed that what was first bought is what will be issued out first in that sequence. So, for example, we had a balance of 100. So, when we are issuing out, when we are selling, the cost of sale will be 100 times 50, which is assumed to be that the first one that we had, our closing balance, is what we first issue out. And that is why you have 100 times 50, which is 5,000. Then the remaining will be from 100, from this 300 we received on the 5th of April times 60. You can see the cost. It will give you 60,000. It will give you 6,000. 5,000 plus 6,000 minus 23,000. That's 11,000 minus 23,000 is what will give you 12,000. And now the balance of what we will have will be what? 200, because we sold what? 200 quantity. 400 minus 200 will give us what? 200. Now on 14th July, we purchased 500 at 70 naira. 500 times 70 will be what? 35,000 naira. 200 plus 500 we give you what? 700. And now we have a balance of 200 from the last consignment we bought and 500 now. So it will give us a balance of what? 700. But the price we bought it is 60 and 70 naira, which will give us a total of what? 47,000. 12,000 plus 35,000 will give you 47,000. Now, on the 25th of July, we sold 200 units. What will be the cost of sales? It will be what? It is assumed that the first thing that was received is what will be the first that will issue out. Now, remember, out of these 300, we have issued 100. The balance of 200 is what will be issued here. And that is why you are seeing what? 16 naira. 200 times 60 will give you 12,000. That means what? The 300 of 5th of April has been exhausted. And that is why you are seeing the balance to be 500 times 70, which is this, which is 35,000. 22nd of October, we received another 200 times 80, which is 16,000, which will give us a balance of 700 units. 16,000 plus 35,000 will give us what? 51,000. On 23rd, we issued out 200. This 200 will be from what? The 500 in 14th of July. And that is why we have 17 naira. What will be the balance? 500, which comprises of 70 and 80 naira. That will bought 70 and 80 naira. The balance will be 51 minus 14,000 will give you 37,000. On 12th of December, we issued out 200 again, which will still be this 70, because what? This is 500 that we received. 200, it still gives us, that means we still have a remaining of 100. And that is why our balance is 300, which comprises of the consignment that was bought at the rate of 17 naira and at the rate of 18 naira, which gives us a balance of 23,000. So if the company is valuing their stock using the formula FIFO, their closing stock based on cost will be what? 23,000 naira. Now, based on the average, the weighted average cost, sorry, is supposed to be written weighted average cost, was an oversight. I'm so sorry about that. This will be corrected and sent to the chart. Based on the average cost, I want you to look at this very well. Look at it very well. If you have your calculator close to you, it will be fine for you to bring it out at this time, because we would need to do some calculation. So now, on 1st January, we had a balance of 100. 100 times 50 100 times 50 will give us 5,000 naira. And that's what we have here. That's what we have here. Now, they bought what? They bought 300. We received 300 at the rate of what? At the rate of 60 naira. 300 times 60 will give us what? 18,000. Are you getting it now? But using the weighted average stock, for you to get your closing balance, the unit price of your closing balance, this is how you go about it. Now, we have the price, we have the balance of 5,000 naira, and we receive 18,000. 18 plus 5,000 will give you 23. What is the unit you have? You have unit of what? 400 unit. To get your weighted average price for this balance, it will be what? 23,000 divided by 400. What do we have? 57.5. So you are not to use what? Either 50 or 60. The weighted average cost is the cost of the item divided by the units available. 23,000 divided by 400 will give us what? 57.5. On the 5th, on the 9th of May, we issued out 200 naira, 200 units. 200 units times what? Times this price, 57.5. 200 times 57.5. 200 times 57.5 will give us what? 11,500. 11,500 minus 23,500 will still give us 11,500. 11,500 divided by 200 naira will give us 57.5. Now, on 14th July, we receive 500 at the cost of at the cost of 70 naira. 70 times 500 will give us what? 35,000. Now, your 35,000 plus your balance, which is 11,500 plus 11,500, will give you 46,500. 46,500 divided by the quantity that you have now, divided by 700, will give you what? 66.42857. The same thing as 66.43. If you multiply this by 700, you will get 46,500. Now, on 25th of July, you can see that this is different from FIFO, because FIFO has the assumption that the first thing that was taken in is the first thing that will be taken out. No, but this weighted average cost is telling us that we are going to do what? What is the cost of the item we have, of the total item we have, divided by what? The quantity. We give us what? The weighted average, which is what we are doing now. So, for example, on the 25th of July, we issued out 200. We are not concerned if it's the first thing that was taken out that was taken in. If it's the first thing that was taken in that will be taken out. No, we will just do what? Do a weighted average. And that is why you will see here, 200 was issued out. We still have 66.4285. If you multiply this together, you get this. Subtract this from the balance, 46,500. You have 33,214.29. On the 22nd of October, we received 200 again. Multiply by 80, that's 16,000. I told you, add the receipt with the balance, which is 33,214. What do we have? 49,214.29. Divide it by the quantity available, which will give you what? 70.306. Under weighted average, you are not concerned about first in, first out. We are just doing what? Whatsoever quantity we have as our balance, divide it, whatsoever is the cost of the item we have as our balance, divide it by the quantity available to get what? Your cost per unit. You can see under this, we have 270.362. We did not receive anything. That is why the cost remained the same. At the end of the day, you can see what is our balance. Our closing balance is what? 21,091.84. The same thing as 21,092. You can see the difference between what? The FIFO and the weighted average cost. Do we have any question on that? Any question before I proceed? If we don't have any other question, if you don't have questions, I can proceed. Now, having fully understand the inventory IS2, we move to preparation of non-for-profit account. I know when you were doing your BMF, we talked about, it stated about business organization. And we said business organization, we have the commercial organization and not-for-profit organization. And this not-for-profit organization, their main aim is not to do what? Not to just make profit. You can see many organizations exist. Many organizations exist to achieve other objectives than making profit. Such organizations are called what? Not-for-profit organizations. So we have organizations, their main aim is not to make profits as the commercial organization. The commercial organization, their main aim is to do what? Is to make profit. Example of this organization, we have the clubs and society, we have charities, hospitals, and government bodies. Their main aim is not what? Is not to make profit. Not-for-profit organizations have income, which is their revenue, which they raise or are given, and cost, which must be paid just like other organizations. A not-for-profit organization will try to operate at the level where its income is slightly bigger than its cost. This sounds very much as if the not-for-profit organization is trying to make profit, but that is not the case. A not-for-profit organization might try to operate at a slight surplus so it can continue to provide service in the future. So you will see some of all these clubs, Rotary clubs that you see, they are not a profit-making organization. What they do is just to make sure that they have surplus so that they can continue to provide what their services. Like Rotary Club, most of the things they do is what? Charity. It's just like a charitable organization. A profit-making entity tries to make as much surplus as possible in order to enhance the wealth of its owner. So you can see now the difference between a non-profit-making organization and a profit-making organization. The main aim of the profit-making organization is to what? Have enough surplus to increase what? The wealth of the owners. But for the non-profit making organization, their aim is just to make slight surplus so that what? They will continue to provide the services that they are rendering. The same thing like Rotary Club. Their aim is not to make profit. They don't have competitors. They are not set up to increase the wealth of the owner. So this not-for-profit organization, they need accounting records because they could not continue to operate if their costs are consistently bigger than their income. What is the accounting for not-for-profit organization? Not-for-profit organization might be subject to less regulation than profit-making organization. Through this, by no means of true of all not, and this is not true for all not-for-profit making organization. Some organizations may not be required to prepare accrual-based information. They may prepare a cash-based receipt and payment account. Instead, organizations that do this might include clubs, societies, and perhaps some charities. Other not-for-profit organizations prepare income and expenditure. So we have the receipt and payment account. And the receipt and payment account shows what? Shows what? Cash receipt and cash payment. Or why some other not-for-profit organizations, they have what we call income and expenditure that is based on accrual basis. The receipt and payment is based on what? Cash basis. Only cash are recorded. But you can see here some other not-for-profit organization, they will have to present what? An income and expenditure account. Different terminologies used. Now you can see here what a statement of comprehensive income would describe as profit for period. An income and expenditure account described as a surplus of income over expenditure. So we have statement of comprehensive income for profit-making organization. What it will describe as profit for the period. Income and expenditure will describe it as what? Surplus of income over expenditure. What a statement of comprehensive income will describe as loss for the period. Income and expenditure account will describe this as a deficit of income over expenditure. So majorly, what a profit-making organization call profit is what a non-for-profit making organization calls what? Calls surplus. And what a profit-making organization calls loss is what a non-for-profit making organization calls what? Calls deficit. Now, in the statement of financial position, a company has equity reserve, whereas a non-for-profit organization has equity fund account. In the statement of financial position, a company will add the profit for the year, deduct a loss to an equity account called retained profit. A non-for-profit making organization will add surplus to an equity account called an accumulated fund. We will see all those accounts. Now we have receipt and payment account. Receipt and payment account does not apply what? The accrual concept. That is, it only applies what? The cash basis concept. That is, only cash receipt and cash payment are recorded. The receipt is on the debit side and the payment is on the credit side. You can see features of this receipt and payment account is that all cash receipts and payments made by concern during accounting period are recorded in the book. Therefore, the receipt and payment account is a summary of cash transactions. Then two, all receipts, either cash or bank, are recorded in the receipt column of receipt side, where all cash and bank payments are recorded in one column of the payment side. All cash and receipt and cash payments, irrespective of capital and revenue. So we are saying irrespective of it is capital or recurrent, we will post them to be a receipt. If it is cash, the bottom line is that they must be what? Cash payment and what? And cash receipt. Low an illustration, you can see this is the illustration of a receipt and payment account. You see, a receipt and payment account gives far less information than a set of what? Statement based on their concept. Now you can see in this receipt, I told you that in the receipt and payment account, we record only cash receipt and cash payment. Now we have what we call subscription. Now, how do we calculate this subscription? Because the subscription you see here is the subscription that is received, the cash receipt based on subscription. And you will understand that subscription, for example, in a club, every member has subscription that is entitled to pay for the year, but there are some people that will be owing that will not pay, and there are some people that will overpay. Some people might pay subscription for 2 years or 3 years in advance. How do we treat this? How do we ascertain what the subscription that was received in cash? This is the main source of cash for club will be membership fee. It may be necessary to calculate the cash received from members during the year. This is complicated. Why is it complicated? Members who pay their fees in advance are creditors of the club. Members who are in arrears are debtors of the club. The amount of cash received in can be calculated using a subscription tier account. You can see this is the subscription tier account. That means we have on this debit side balance be the members in arrears, because what? They are our debtors. They are an asset to the company. That's why we put it debit. Balance be the members who have prepaid. These are our creditors, people that have paid in advance. Income and expenditure. What is the subscription that people are supposed to pay in the year for 2020? What are they supposed to pay? Is it 2 million, for example? Then what members who have prepaid? Who are the members who prepaid for this year? Who are the members who prepay, who are in arrears for last year? Then we have cash. What is the cash we collected? This example will give us a broader view of it. So we see, example, a club has 500 members. Annual membership fee are 1,000 naira. Therefore, membership fee for the year should be 500. Therefore, the club subscription record for the year ended 31st December 2013 show the following. Subscription received in advance for 31st/12/2012 is 10,000. 31st/12/2013 is 6,000. Subscription in arrears is 18,000 and 12,000. We can fix this in where? Inside the T format subscription account. You can see subscription in arrears, balance brought down, brought forward. You can see arrears 18,000. Advance 10,000 for 2012. Now, income expenditure. What is the subscription that's supposed to pay for the year? Is 500,000. And they have given us what? The advance of 6,000 for this year. And subscription in arrears is 22,000. This is the cash. This is the cash received for what? For subscription. That will be taken to where? Your receipt and payment account as what? Subscription. Do you understand? Now, like I told you, some clubs might be required or they might accept the accrual method where they need to present what? Their income and expenditure account. And in this income and expenditure account, it uses what? The accrual basis. Like I told you in the receipt and payment, it does not use accrual basis. What does it use? It use what? The cash-based method. So you will see the accrual based means the different types of income of a club followed by different category of expenditure. You can see membership fees and subscription, live membership fee, donations to club, investment in income, surplus from running a coffee bar or a shop. Note that if a club has a coffee bar or a shop or runs an event, the profit from this is a general calculated separately in an account known as trading account. So, for example, if a company has a side business, maybe they sell coffee, they have a bar where they sell things. So we are saying that bar itself, you need to prepare what? A trading account for that bar. So whatsoever income that is from the bar will now be transferred. You can see coffee bar shop profit. Looking at it, you see coffee bar trading account, you can see income, which is sales, opening inventory, purchases, less closing inventory. They get cost of sale, then you get the profit. The profit, you will see it in the face of the income and expenditure account. So this, all the cost of sale and sales of the bar should not be in the income and expenditure account. It should have a separate trading account. Look at it. You can see at the end of the day, you either have surplus or deficit of income over expenditure. Now we see life membership fees. A club should have an accounting policy for this. Possible policies include recognition as income when received, recognition as income over a specified period, or recognition in an equity reserve. So life membership fees for some members can pay a life membership fee. Maybe the club can decide that, okay, we have annual membership fee, but if you want to be a member for life, you can pay this certain amount. They can say, for example, to be a life member, just pay 10 million. So how do we recognize this in their books? They said there are 3 ways that can be recognized. That is recognition as income when received, recognition as income over a specified period, and recognition in an equity reserve and accumulated fund. How do we recognize this as income when received? That is, when the money is received, just do what? Debit bank and credit what? Income and expenditure account. Or recognition as income over a specified period, that is debit bank and credit what? Deferred income in your statement of financial position. Now, each year, what they are saying is that the first thing you will do is do what? Is to do what? Debit bank and credit what? And credit your account in the face of statement of financial position. So it will be under non-current liability as what? Deferred income. So every year, what do? You are going to do what? Debit the deferred income, that is your financial position, and credit what? Income and expenditure. So you will be reducing the income every year with the amount for each year. Then what is the last method? They said the treatment recognizes the amount received as income over several years in the accumulated funds. So you are seeing it. So debit cash received and credit what? And credit the accumulated fund. That is the equity of the non-for-profit organization. Now we have also donations. Donation. A club might receive a donation or a bequest. If the donation has not been made for a specific purpose, the club might recognize the donation as income in the period in which it's received. A club might receive a donation for a particular purpose. For example, a member might donate money for a new football pitch. In this case, the money is credited to a fund account set up for that purpose. Set up for that purpose. So, for example, if the reason why the donation was made was not specific, then you can do what? You can just debit cash and credit your income account. But when it is for a specific purpose, we said that you would do what? Debit cash and credit what? And credit football pitch fund. Let's see an example, a question to show us how these accounts are prepared. Now, look at this question. The following is a summary of the receipt and payments for the year to March 31st, 2016. These are the receipts and these are the payment. Other relevant information at the beginning and end of the year is as follows. Subscription due, subscription paid in advance, rate owing, bar inventory, club premises, furniture cost, bank balance. Club bar trading for the year ended 31st. So you are required to prepare the club bar trading for the year ended 31st December. The income and expenditure and the statement of financial position. Now, I told you that the bar trading, you have to prepare when when a not-for-profit organization has something like a bar or a separate business, you have to prepare their trading account. So you can see sales. What is the sales of the bar? What is the sales of the bar? $405 bar takings, 405. So we have 405. What's our opening inventory? This is our opening inventory. Opening inventory, April 1st, 2015. Opening inventory. What is our purchases? Is there bar purchases 277,500. You add it to get cost of goods available for sale. Then you less what? Your closing inventory. You get what? Your cost of sales. Subtract it from your sale, you get the gross profit. We have gotten this gross profits. We can go ahead and prepare what? Our income and expenditure account. What is our income? They have given us the income for the year. Club subscription. Now for subscription, I told you that you will go out and prepare what? And prepare the subscription account, and that is why you are having working one. So let's go to working one to see how this is being done. Working one. So you can see subscription due brought forward. Subscription due, that subscription in arrears. See 13,500. 13,500. And subscription paid in advance, April 1st, 2015, is still showing that also. 750. Income and expenditure. What is the subscription they are supposed to pay for the year? Is here, 255. You can see it. Sorry, 200 and what? 255,000. No, 249,750. Now, hard subscription in advance, less subscription due. This 255 is what? Is a balancing figure. This balancing figure is what you take to what? Your income and expenditure. Sorry, is what you take to your, sorry about that. Okay, so I'm so sorry. Now, you will see in this place, we have receipts. That means this is the cash that was received. So now we have to get what? We have to work back to get what? Our income and expenditure, what we need, what they need to pay for the year. This is what was received. That's why you will see it under receipt. That is cash receipt. So if you add this together, subtract it from 15 and 35, you will get what is supposed to be paid for the year 2016. So that's why we have subscription. Then donation is what? 22,500. And what? Bar gross profit 135. Christmas dance. Christmas dance 12,750. Expenses is what? 2,250. Christmas dance expenses, you can see, is used to reduce it immediately. We get what? 417,750. Rate. Why are we going out to do our rate separately? You can see rate owing, April 1, 2015. Rates still owing as at March 31st, 75. Let's know what is the actual rate they are supposed to pay for the year. And that is why we came here and see, okay, cash 13,500, balance brought for us 16,500, balance carried down, income and expenditure will be what? 14,250. And that is why we have what? 14,250 here. General expenses is in our question. Premises and furniture. Premises and furniture. We have 30,000 and 15,000 naira. $300 minus 270 is what? Is 30. 45 minus 30 is 15. That looks like what? Depreciation. That is our depreciation. If you see, we have what? This is this income. This is the expenditure. We have a deficit. This deficit will be taken to where? To our statement of financial position. What is our assets? Premises. 750 minus 480, you have 270. This is our asset. We have our closing inventory. Subsidy due 9,000 naira. Cash and bank is an asset. What is our equity? Our equity, accumulated funds. Bad takings 405. 405. Accumulated fund, come down, working 3, accumulated fund, come and see our accumulated fund. So we need to do a statement of affairs as at 31st March. Look at the statement of affairs. The statement of affairs shows what? Your asset plus your non-current asset plus your current asset minus what? Your current liability. Is just like what? The same thing as our share capital, where you will add current asset plus non-current asset minus current liability. You have your what? Accumulated funds. What forms your current liability? Subscription in advance. That's what? Prepayment. Rate owing. You have enjoyed it, but you have not paid. Is what? Is a liability. So subtract it, you get what? Your accumulated fund. And that is what is here. We have our deficit, which is going to be subtracted at the end of the day. You can see what? A balance of 379,500. 379,500. Please, guys, you can now unmute yourself and ask questions if you are not clear with any of the topics I've treated today. Please unmute yourself and ask the questions. Gina, Matthew, Patricia, I need your response, please. You don't understand any particular question? You don't understand any particular topic? You want to ask questions? The floor is open. You can go ahead and ask your question. Are we cool with the class? Are we cool with these two topics? I need responses, please. Patricia, are you clear with the inventory and the accounting for non-profits making organization? Olaju Matthew, do you understand? Gina, do you understand? Okay. So if we are all okay with the class, we can call it a day and we'll meet next week. Thank you very much for your time and have a good night rest. Thank you. Good night.